Many investors are head over heels for Apple's stock, seeing it as a vehicle for substantial capital gains. However, for dividend-focused investors like me, it doesn't make the cut. Sure, Apple has seen its stock surge by a whopping 41% in the last year, making it the darling of many portfolios. But when it comes to dividends, Apple's performance leaves much to be desired. Despite being a cash flow giant with a robust balance sheet, Apple's commitment to rewarding shareholders through dividends has been lackluster. The company's dividend increments have been modest, with just a meager 1-cent increase since the stock split in 2020. It's a stark contrast to the enthusiasm seen in the surging stock price. Apple gets a lot of attention, and it's not surprising given the plethora of articles flooding the platform daily. A significant reason for this constant coverage is the fact that Warren Buffett is a major shareholder. However, that underscores the point. People don't invest in Apple primarily for its dividends, which are relatively low. It's not due to financial constraints. Apple could quadruple its dividend, and it would still be comfortably covered by its cash flow. Moving to Apple's latest Q4 earnings reported in November, the tech giant did what it usually does: beat both top and bottom line expectations. Revenue hit $89.50 billion, and earnings per share stood at $1.46, up from $81.8 billion and $1.26, respectively, in the third quarter. This translated to growth rates of around 9.4% and 16% quarter over quarter. Despite a challenging macro environment, Apple sustained impressive growth. Notably, the company achieved record revenue in populous countries like India, Brazil, Canada, Mexico, and Saudi Arabia. Since its 2020 split, Apple has raised its dividend by a mere 1 cent, maintaining its status as a dividend contender with over a decade of consecutive increases. Currently standing at an annual payout of 96 cents, it's speculated to reach $1 or 25 cents per share in 2024. While some argue an increase is better than none, incremental raises from a behemoth like Apple are disappointing for shareholders. While some companies make small percentage increases to maintain streaks for aristocrat or king status, it seems Apple isn't prioritizing this dividend streak. Despite raking in approximately $100 billion in net income and free cash flow over the last 2 years, the company has paid out roughly $15 billion in dividends, resulting in a low payout ratio. This ample financial room suggests that Apple could afford more substantial dividend hikes if it chose to do so, especially considering its relatively low capital expenditures, averaging around $11 billion over the same period. Here are the anticipated cash flow numbers for Apple over the next 3 years. Free cash flow is predicted to grow by nearly 19% from the close of fiscal year 2024 to 2026, mirroring the expected growth in cash from operations. Apple boasts a robust balance sheet with substantial liquidity. If the company decides to reward shareholders with a special dividend akin to cost, they could tap into their free cash flow or the $30 billion they had on their balance sheet at the end of Q4, with only $9.9 billion in debt maturing this year and $10.7 billion in 2025, coupled with an A credit rating. Apple is in a strong position on the debt front. Over the last 2 years, they've steadily reduced their debt, further affirming their financial resilience. However, Apple is not immune to risks, and one significant threat is a potential share price decline. Over the past year, the stock has surged by 41% from $133 to the current price of $186. While many stocks have faced volatility due to recent macroeconomic conditions, Apple's stock price has been an exception. This presents a notable risk, as stocks experiencing a substantial run-up often undergo some form of price correction. Yet, some continue trending higher, as seen in the case of Costco. However, the adage, "what goes up must come down," could potentially apply to Apple's share price. Additionally, with talk of a looming recession, Apple could face challenges, potentially witnessing not only a decline in share price, but also in revenues and earnings. High unemployment might lead to reduced consumer spending on their products. Wearables and accessories could suffer a revenue slump as consumer budgets tighten, adding to the existing 34% year-over-year decline in Mac revenue. Furthermore, the company is embroiled in a pending lawsuit, which led to a temporary halt in the sales of its smartwatches due to a patent dispute. While they've been allowed to resume sales for now, the return is temporary and could negatively impact Apple Watch sales if restrictions are imposed again. Apple's Vision Pro might make its international debut before the Worldwide Developers Conference, WWDC, in 2024, according to Ming-Chi Kuo, an analyst at TF International Securities. The plan is to unveil more development insights about Vision OS to a global audience at the WWDC in 2024. Kuo suggests launching Vision Pro in non-US markets before the event could be strategic for fostering the global development ecosystem of Vision OS. The Vision Pro mixed reality headset is set to release in the US on February 2nd, with pre-orders starting at $3,499 for the 256 GB version from January 19th. Kuo notes that the delayed international launch is attributed to initial supply constraints, a cautious approach to ensure a smooth sales process in the US, and the necessary time to adjust algorithms to comply with regulations in various countries. Originally announced in June, the Vision Pro represents Apple's most significant product launch in nearly 10 years. However, there were delays in its launch, with reports in July 2023 stating that production targets were scaled back due to manufacturing challenges. Amazon and Apple are gearing up for a competitive year in the streaming arena, leveraging unique strategies to solidify their positions in 2024. While heavyweights like Netflix, Disney, and Warner Bros. Discovery had a significant 2023, it's crucial not to underestimate the streaming moves made by Amazon and Apple, even as their primary businesses extend beyond content. Amazon, renowned for e-commerce, doesn't aspire to be the streaming giant. Instead, it strategically employs content to enhance its broader services. Its catch-all approach, bundling movies, music, games, and the enticing two-day shipping perk, positions it uniquely. Despite monthly options, the full annual plan remains popular for its comprehensive offerings. Apple, on the other hand, takes a distinctive route, allowing users to tailor their content bundles. While bundling is an option, the careful selection of top-tier offerings, some exclusive to premium packages, offers flexibility. Though this approach might seem costlier, depending on preferences, it can be competitive with or cheaper than major rivals like Netflix, Disney, and Warner Bros. Max. Contrary to the misconception that streaming is solely about TV and movies, Amazon and Apple showcase its diverse facets, making them compelling value players. Beyond the conventional, Amazon offers fast deliveries, and Apple incorporates a fitness program into its streaming ecosystem. However, as they may not match other platforms in content quantity, Amazon and Apple prioritize content quality. Originals, distinguishing them from acquired content, become the cornerstone of their streaming strategy. Both companies recognize the significance of awards, and their streaming strategies reflect this. The focus on originals over acquired content indicates a commitment to content with lasting appeal. Apple, the tech giant currently under a bit of scrutiny, is navigating a somewhat stagnant phase, marked by concerns about iPhone sales and overall hardware performance. Recent downgrades from Piper Sandler and Barclays have added to the scrutiny, citing worries about the iPhone 15 and other hardware-related issues. Additionally, Apple's valuation is on the higher side, trading at 26 times forward EPS estimates with a modest expected EPS growth of around 8% next year, resulting in a relatively high 3.25 PEG ratio. However, despite these temporary hitches, Apple's stock starts to look compelling around the $150 range. Even with a forward PE ratio above 20, several positive aspects of Apple's narrative come into play. There's substantial growth in its services and wearable sectors, which provides a cushion. Anticipated rebounds in iPhone sales, coupled with the potential return to growth in China sales, are encouraging signs. Apple's stock has had its fair share of ups and downs, going through periods of slow growth, weakness, and sideways movement. We've observed this trend during the 2014-2016 phase, another slow growth stint from 2017, 2019, and a sideways phase around 2021, 2022. Currently, Apple seems poised for a consolidation before making its next upward move. A significant chunk of Apple's revenue, approximately 50%, still comes from iPhone sales, making the company quite reliant on its performance. In the last quarter, iPhone sales saw a modest 3% year-over-year increase, following a 3% year-over-year decline in the previous quarter, indicating a certain softness in this segment. This situation is not entirely new for Apple, especially considering the saturation in the market with the iPhone 12, 15 models. The current design has been around for a while and might be losing its allure. The iPhone 15, for instance, looks strikingly similar to its predecessors, providing little incentive for users to rush into an upgrade. However, the tide is likely to turn when a significant redesign occurs, bringing in advanced features. Rumors suggest minor tweaks for the iPhone 16, but it's the iPhone 17 that might witness major adjustments akin to the revolutionary shift from the iPhone 8 to the iPhone X. Services revenues are on a robust growth trajectory, clocking a 7.7% increase in sales in the last quarter. Not only that, but services are steadily claiming more substantial revenue, with annual figures anticipated to hit the $100 billion mark by 2025. Shifting our gaze to China, there's been a recent hiccup in iPhone sales, reportedly plummeting by 30% in the first week of 2024. Adding to the woe, 2023 witnessed a dip of around 3% in sales compared to the previous year. The most recent quarter's China revenues clocked in at $15.1 billion, trailing behind the $15.42 billion from the same period the year before. Blame is placed on the new flagship models from competitors like Huawei and Xiaomi. China, despite being Apple's third largest market after the Americas and Europe, is facing a slowdown. However, this downturn in China doesn't appear to be a long-term narrative. It circles back to Apple's somewhat stagnant and relatively pricey iPhone lineup. The so-called new models aren't exactly turning heads anymore, with designs remaining largely the same, barring a few color tweaks. Yet, Apple continues to reign supreme in the electronics hardware realm. The silver lining for Apple is on the horizon, both in China and globally. The iPhone, with its enduring status as a top-tier smartphone and a symbol of prestige in many countries, remains a coveted device. Even if some users temporarily switch to explore other options like Huawei or Xiaomi, there's a strong likelihood of them coming back to Apple when new iPhone iterations hit the market. Wearables took a hit with a year-over-year decline in the last quarter. We're navigating a somewhat sluggish economy, pesky high interest rates, and a mix of other challenges. As the economy flexes its muscles and the Fed adopts a more user-friendly monetary policy in the coming years, this segment is likely to bounce back. Let's not forget that Apple's AirPods are no small fry, contributing around $10 billion in annual revenue, and the Apple Watch segment is no slouch either, chipping in about $14, $18 billion in yearly sales. Expect growth to pick up steam in these product segments and keep an eye out for Apple's Vision Pro headset, betting on it racking up some impressive sales growth. Sure, Apple's not exactly a bargain right now, sporting a hefty 26 times forward EPS estimates. But, and it's a big but, if Apple keeps consolidating and takes a dip into the sweet $150, $160 buy-in range, next year, Apple's earnings should dance around $7, $7.50, meaning the PE ratio would cozy up to the 22 range in that $150, $160 territory. Given Apple's global dominance, fat profit margins, promising growth outlook, and a bag full of other advantages, a 22 PE multiple or even more seems justified. Apple remains a stellar company for growth investors, but for those focused on dividends, it falls short. Although it's a cash cow with a robust balance sheet, the company could comfortably afford more substantial dividend hikes.